Honourable Ministers, Members of Parliament, ladies and gentlemen, friends and colleagues. Obviously it's a great pleasure to be back here in Uganda, in Kampala. Whatever the weather, I suppose I should qualify that comment with, but a great pleasure to be back here. And also a great pleasure to be involved in what is, I think, a really important event. This first meeting where all the Africa programs of the IGC have come together in Africa for this Africa Growth Forum. So it really is a pleasure and a privilege to be involved with this. This session is obviously on natural resources, which, as we all know, create fantastic opportunities for Africa, but opportunities that come with considerable risk. What I want to do in this talk is just run through what I think some of the main areas. It's not going to be an exhaustive overview, but some of the main areas which I think are important for policymakers, but are also areas where a good deal of research has gone on in recent years, and a good deal of that under the structure of the IGC. So I'm going to try and do a combination of new research ideas and policy important questions, which is obviously what the IGC is good at. But as I go through this, of course, there'll be areas where research has made progress, where we have learned things, but also areas where more research is needed. So there's going to be an emerging research agenda from some of the things I'm going to be talking about. So those four areas that I thought I'd concentrate on are the ones that I've put on this slide. So I want to say a little bit first about what we know about the rather sort of aggregate, broad overall effects of resource abundance on economic performance in countries and regions. And that's quite an old literature, but it's one where progress is being made, where research is going on. So I want to say a few words about that. Then I want to turn to revenue management issues, where a good deal has been done, I think, where thinking has changed, and obviously centrally important. A lot of that work has been quite analytical, so you see I've pulled out a separate heading there, implementation. It's all very well to do the analytical stuff, but implementing it on the ground is really important as well. So that's the third of the headings I've got there. And then partly because of its intrinsic importance and partly out of deference for the title which I was assigned, the last heading here is obviously trying to get long-run growth, trying to use resources to generate something sustainable that will truly transform economies and raise growth in the long run. So they're the four headings that I want to talk through. And I've just got one slide on each, and then we'll endeavour to keep to time, but please do stop me if I'm failing in that regard. Okay, so the big picture stuff. What do we know about the impact, the overall impact of natural resources on economic performance? As I said, there's a long-standing literature there going back into the 80s, Saxon, Warner, these things. Really pointing to, on average, statistically, the adverse effects of natural resource abundance on economic growth, on savings rates, on a whole number of indicators. So research that goes way back, and obviously the term resource curse came out of that old literature. That's been nuanced and refined in many ways. Work, maybe a decade ago, interacted that with governance. And of course, the news is not entirely good for many African economies. Essentially, if you, when you interact resource abundance with governance, resource abundance and good governance translates into faster growth. Resource abundance and bad governance translates into slower growth, with the with the borderline between the two being sort of about Botswana, the governance of standards of Botswana. So concerns in that second round of literature. And then more work beginning to sort of unpack that, get into detail. For example, the importance of volatility, the volatility of resource revenues in determining its impact on economic performance has come out of a lot of work. But that's very, very broad, aggregate, cross-country stuff. I mean, modern research has to drill down into a lot more detail than that. There's really nice work going on now, not just looking at the cross-country level, but looking subnationally, particular regions, particular areas, the neighbourhood of a mine or an oil field, exactly what's going on. That work helps statistically with really identifying effects, which is important. It also helps in separating out some of the mechanisms a bit, not all of them, but for example, separating out what is a sort of revenue transfer effect and what is an impact on the local workers, local economy. But what do we learn from that? Well, there's nice subnational work on Brazil, where as you look at Brazilian districts, those that receive a lot of resource revenue do not have better public services, they have slightly worse ones. So negative effects of revenue transfers coming through that subnational stuff. But more recent work looking, as I say, in the neighbourhood of a mine, how does that help the local economy, the direct impact? So there's work on gold mines in Peru, oil discoveries in Indonesia, some work on Tanzania, some work on Zambia, giving a rather more positive, if small-scale message. It does benefit the local economy. Some of the work on Tanzania, it does benefit women. When women move from some out of agriculture into services, getting higher incomes in that. So that local impact stuff is an important area where work is going on and a key to understanding things. But also at this broad picture level, it's terribly important to look at the country detail. The statistical analysis gets you so far, but really looking at the experience of particular countries is terribly important. Collier and I edited a book a couple of years ago with case studies for, I don't know, eight or nine countries. And of course, what you learn from that is that the problems that countries have, countries that do badly all do badly in different ways, basically. Lots of things can go wrong in this process. I've listed a few of them here. Failure to capture revenue. Zambia is the classic example there, where copper revenues just weren't captured by the government. Boom and bust. Lots of countries done that. I mean, Cameroon's the example I've put here. There's a chapter on it in the book. Saving too little. Well, many countries save too little of the resource revenue. Nigeria is the example we've put here, where obviously these measures of real savings were negative. You were running down resources faster than you were building up other assets, so you're really sort of negative saving going on. A really curious example is Kazakhstan, where it's as if the government did all the right, did everything right. It got the resource revenue, invested it in special funds, but at the same time it deregulated the financial system. So private banks went and borrowed internationally about as much as the government had saved and invested it all in the property market, and there was boom and bust and terrible mess. So countries going wrong in their own particular ways, and of course some going right, and the next speaker will talk about Botswana, so I will say nothing about that. But what we get from this then is a complex picture. Research is making progress in drilling down, understanding particular countries, particular mechanisms, progress being made. But of course the overall message, I guess, is it is a weakest link problem. Lots of things can go wrong. You need to get them all right. You can fail in many ways. So it's sort of concerning but important message from that. Now let me say a little bit about revenue management. And this is an area of active research in my centre in Oxford and with the IGC. The question here is, okay, suppose that you're confident, either that revenues are flowing into government or confident expectations that they will be flowing in fairly soon on some time horizon. Then what do you do with the revenue? What should your spending, saving, investing strategy be? Let me say a few words about that. In the broadest terms, and this is going to be very broad and aggregate for the moment, in the broadest terms, you can do three things. You can use the revenue for additional current spending, consumption if you like, so current flow. You can use it for increasing investment in the domestic economy, so capital domestically, or you can use it for building up foreign assets, so accumulating capital, but offshore in foreign assets. That's it, right? Those three things are going to sort of add up to the incremental resource revenue. So the question is, what balance of those three things should you have? And the little sort of schematic thing I've put here is obviously supposed to illustrate that. So you've got a resource revenue flow that's sort of wobbling around through time, and then I've put a possible path of current spending, that lowest line, on top of that domestic investment. So the sum of those two things being spending in the domestic economy, but some of it current, some of it capital. And the residual, the gap between the black line and the blue wiggly line, is foreign asset accumulation. So in the boom times, there's positive foreign asset accumulation. If revenue is low, there may be negative running down these funds. Okay, that's a little sort of schematic picture, but it's supposed to illustrate three principles that I think are important when you think about revenue management. The first one is investment in the domestic economy. Your capital scarce. As the Prime Minister said earlier, there's an infrastructure gap. So investing in the domestic economy, important. That's the largest element, as you see in that little schematic illustration. So message one, investment in the domestic economy. Message two, saving, which is the sum of foreign asset accumulation and domestic investment. So saving as a whole should be a high share of this resource revenue, and probably a rising share as you run down the resource. Rising for two reasons. One is that as you move through time, the amount of resource left is getting smaller, and getting smaller and for a shorter period as you move through time, and therefore it's important to save more of what is looking more like a sort of spike rather than a protracted period of revenue. Important to save more for that reason. And also because in the early days you do have genuine, real poverty reduction needs. So getting some out into consumption is fine if you have urgent poverty reduction needs. So saving, high and almost surely rising for those reasons. What about the role of offshore funds? Well, that's almost the residual now, right? We've got three things that have got to add up to the revenue flow. But a couple of important points, I think, about the role of offshore funds. I mean, conceptually, you can use those funds, again, to do three things. One is stabilization. The other is long-term intergenerational savings funds, building up your sovereign wealth fund internationally. Or the third is what I call a parking fund, which is just putting revenue offshore for a time. My views on this is that short-run stabilization funds are necessary and good and should be built up. Working out the optimal levels, the size of such funds is difficult, but it's really important. Offshore intergenerational savings funds are fine for Norway, but really pretty inappropriate for African countries where you need the saving, the investment to be translated into domestic capital, not holdings of foreign assets. There are political economy reasons for that, but fundamental reasons of the need to fill the infrastructure gap. So the intergenerational, the Norwegian style intergenerational funds, I don't attach much importance to in this context. But really importantly, that black line needs to be smooth. You've got to stabilize the economy, and you can't suddenly build up investment in a very sharp manner. It's going to have to grow smoothly, and I'll say a little bit more about that in a moment. It's going to have to grow smoothly. And that might mean that you park revenue offshore until you can spend it effectively in the domestic economy. That's not parking it for 100 years in a sovereign wealth fund, but it's saying, look, if we spend it now, we'll spend it badly. So park it offshore. So those are the sort of principles we've thought through on revenue management. They kind of look obvious, but they are in pretty sharp contrast to what was the IMF's position. I'm happy to say the IMF has moved a bit, and what Norwegian donors sometimes suggest. It's really getting it into the domestic economy, domestic investment is important. You can't do it instantaneously, park it, but getting it into domestic investment is important. Okay, it's all very well for people like me to say save a lot, invest a lot, but let's talk briefly about practical implementation. Evidently not easy. So the elements on practical implementation I want to talk about are listed there. Controlling spending, spending effectively, and then how at a more micro level do you do it. Controlling spending, obviously with the resource boom there's tremendous pressure for spending now. Some of it illegitimate, some of it perfectly legitimate. I mean, spending ministries have the job of trying to get government to raise spending in their ministries. Legitimate demands, but they have to be met, rather controlled, not met, controlled effectively. Fiscal rules are one way countries have tried to do that, legislating that certain amounts of revenue go into various funds. Chile is the prime example that it's worked. But I think what the research literature tells us on that is that on the whole they haven't been terribly effective. Countries that have really effective institutions and finance ministries, they work in those environments, but in those environments you don't really need them. If you haven't got the effective treasury or finance ministry, they're not going to work, so you're not buying much. So fiscal rules, we need more research, one of those areas. The role of the finance ministry is really important in keeping a check on overall spending. And of course, what I'm particularly concerned about there are sort of quasi-fiscal expenditures going on through national oil companies or whatever. Real dangers there. So the strong finance ministry to keep things under control. And then, of course, managing expectations, managing the demand side. There's this intense demand for spending, but it's really important to set expectations in the citizenry at large as to what they can reasonably expect from this boom. So people aren't going around saying, oh, we're rich, we don't have to work anymore, right? You're not. So that narrative on expectations, really important. Controlling spending, spending effectively. A couple of points here. There will be a boom, partly from the activities in the resource sector, but partly government trying to do what I was showing on that previous figure, increase the non-resource balance, spending in the domestic economy. There will be a boom, but that has to be ramped up slowly because it will hit bottlenecks. One obvious bottleneck is government capacity to design, procure, implement projects. That takes time to develop that. Another one is simply in the response of the economy. If you ramp up spending fast, you're going to get inflation, you're going to get relative price changes, that'll give you bad value, poor value for money. So it's really important to sort of anticipate that, where the bottlenecks are going to be, and try and relax those. There's some IGC Octacar work that we're just getting going in Tanzania at the moment on thinking about the construction sector. As a resource boom comes along, can the construction sector adjust to that and meet the extra demand, or will you just get higher prices and bad value for money? So that's important. Final point on implementing revenue management. It's all very well, to talk about these great aggregate levels, investment, saving, whatever. But of course, it's in the micro detail. What channels do you use? How are funds transferred between sectors? What's going on here? Couple of comments. Some of the funds will translate into current consumption. But how do you do that? Is that the health service, education, social sectors like that? Is it tax cuts of various sorts? Is it fuel subsidies? Are you doing conditional transfers? Are you doing citizen dividends? A lot of detail in those choices. We know about the effects of an increasing stock of research knowledge on the effects of these different channels. But I think we need more work on their effects in this particular context of resource abundance. Remember, we want high savings out of this stuff. So citizen dividends, to me, don't seem a great idea. I suspect one of the other speakers may take a different view on that. but you do need high savings out of this. So thinking these things through in this particular context is important. And then, of course, I've been talking about investment. Yeah, there's public investment, but ultimately it's private investment that you want. So how do you do that? Well, you can raise the rate of return, hopefully, by doing the business climate stuff and the infrastructure improvements, you know, the spending on infrastructure that raises the return to private investment. Or you could do it a bit differently. You could try and bring down interest rates by government buying back debt, or even, I hesitate to say these words, development banks lending to the private sector. Okay, so lots of different bits of micro detail in the transmission mechanisms. How long do I have? Have I gone over already? Sort of 2 minutes. Okay, last, right. Okay, a few words on, the last thing I wanted to say, translating into long-run growth. Obviously, private sector investment is the ultimate driver here, the ultimate driver of growth. So that's to be kept centre stage. A resource boom will cause structural change in the economy. Now, I often go to countries and people say, we've got to diversify our exports. Yes, but there's an uncomfortable fact which comes out of some IGC, Oxford research. As you look across countries, think about the balance of payments of a country, right? You're getting this resource revenue in, okay? As that foreign exchange comes in, you're either going to save it offshore or other exports are going to go down or imports are going to go up. Well, that's a balance payment. It has to add to balance. As you look across countries historically, what's happened? Tiny bit of foreign saving. So for each dollar, 5 cents saving, about 20 cents increase in imports and about 75 cents reduction in other exports. So there is a Dutch disease issue. It's been hard for researchers to pick up in prices and industrial structure and things. But if you look directly at the balance of payments, it is going to be hard to diversify other sectors, well, certainly diversify exports, other exports. You're pushing a bit uphill. But having said that, what can be done on private sector investment? Well, I've already said, the infrastructure stuff, building skills, all that, terribly important. The sort of general purpose measures that might increase the return to private investment, those general infrastructure skills things, tremendously important to do. More controversially, what can be expected, what can be hoped for from actually growing out from the resource sector, using the presence of the resource, not just the resource revenue, but the resource activity itself to grow other bits of the economy? What can you hope for there? Well, it might be growing downstream, it might be growing upstream. Downstream means, sort of if you've got oil, do petrochemicals and something like that. I'm pretty negative about that. Firm commercial criteria are needed to do this, okay? If you don't have a comparative advantage on capabilities in petrochemicals, then don't do them just because you've got oil. I don't know any country that's got rich on the basis of a petrochemical industry, right? So those using the resource for further processing, I'm pretty skeptical about. I'd make some exceptions. If there are very high transport costs of exporting the resource in its raw form, then the commercial decision makes a case for using it domestically. So obviously with gas, that's enormously expensive to liquefy, using it for domestic power consumption is great. Maybe in a landlocked country, some similar arguments apply to oil. But commercial criteria there, I think, are really important. More promising, perhaps, is not the downstream stuff, but the upstream, supplying the resource firms, supplying the sector. That drove some of the local studies I was talking about earlier. We know from the large literature on foreign direct investment in general that local firms often can build capabilities as they come into supply relationships with multinationals. That's not just in the resource sector, that's generally. There's a large literature on these spillovers from foreign direct investment. And of course, the work of John Sutton that's already been referred to is thinking about how local firms can be brought into close collaborative contact with the resource companies to really build the capabilities of local firms. And that's not done just by setting local content requirements 20%, which will be got round somehow or another. It's done by intense, active policy to get the firms talking to each other and training workers and doing all that. Okay, those are the 4 points I wanted to run through. Let me just really make one concluding remark, so forget that slide. A lot of newly resource-rich countries in Africa. We've got historical experience that were distilled through econometrics, case studies, whatever. We've got historical experience. I think it's going to be really important that there's a lot of learning between these newly resource-rich countries. You're all going to be facing similar but different problems. So sharing knowledge, sharing experiences that develops, I think is going to be really important. And of course, this is going to end up as a bit of a plug for IGC. IGC is present in many of these newly resource-rich countries. So there is a research agenda here and a knowledge sharing agenda, perhaps more importantly, that I hope gets pursued actively over coming decades. Thank you.